Chart pattern example case study 72, PCG. This can be considered a spread out triple bottom range since October has two bullish engulfing formations that separate for two distinct upswings. The early development of a descending triangle is quickly ended, but the gap down fill around 14 will still present opposition, rather than just the 1270 level. While the gap fill range is surpassed and PCG stays over 1270, the uptrend line is quickly crossed, and no major bullish initiative is seen. The weak bullish consolidation can point to a possible return under 1270. However, a potential head and shoulders reversal is being delayed despite heavy selling pressure in February. This is why it will be extra important for all time horizons to focus on the 1270 level. A prompt but steady rise begins to present a noticeable incline over 1270. This leads to the characteristic right side of a failed head and shoulders. The potential neckline area was widened to factor in recent volatile price action around 1270. After the uptrend lines are crossed, there is an extended period of characteristic neutral to bearish price action that sees the 3830 level emerge as a major long-term level prior to the resumption to new highs. When a major correction takes place, it is very normal to see the 3830 level become a key support that is very precise, as real bodies form just above it during sharp upswings. Other levels in the 40s are derived from large candles with reversal qualities and candles from gap down and gap fill areas. The combination of a failed ascending triangle and flat top range completing led to an incredible bearish acceleration as shown by consecutive gap downs that are unlikely to be filled soon, since bearish volume was sustained at exceedingly high levels several days after. The bearish reversal is a highly valid swing point and neatly contained within the two patterns. Interestingly, the first two downswings are normal downswings from an invalidated double top that is delayed too long. They form the wider flat top and the upper boundary of the triangle, since they align with the strict triple top range. The multi-year downtrend demonstrates classic bearish continuation price action on an enormous scale with plenty of swing points and gaps forming near prior levels of significance. If the gap downs don't resist too long, there can be a possible bullish reversal, especially since there is now the opposite situation with general three methods rising price action on a larger scale to break the stable downtrend line. Adjusting the developing uptrend line is helpful as the bullish trajectory flattens near gap fill regions but still retains the overall incline to produce a moderate recovery in progress. Now the longevity of the larger uptrend depends on how well a minor double bottom performs against the bearish influence of a double top reversal at a gap down fill area. The bullish spikes in April are a contributing factor in lasting bullish influence. However, this is all short to medium term. It should still be remembered this is after a major downtrend, a gap fill area, and a recent double top range. This is further evidenced by the long upper wick promptly retreating price under the 24 barrier in late June. As soon as the uptrend line is broken, there is a greater chance of a drop directly back into the 1770s. July is almost an exact repeat of April and May, with another double top providing a descending trend line. Here is another reminder to wait for conclusive developments. A bullish reversal was almost complete, but the very next candle after the bullish spike on August 8th neutralized the possibility for a rapid uptrend. Instead, the strong closes below the 1774 level and wider double bottom range increased the chances of another major bearish phase. Indeed, another downtrend emerges and is quite stable, due to the neat price action from April to August, along with the context of the old downtrend and the gap fill range. Here is another case where a pattern's boundaries are expanded due to an influential level in close proximity. In this case, the lower boundary of the double top is widened to account for the gap fill around 1523 that is likely to offer additional support. Due to the greater support potential, the expanded double top range sees a slight delay prior to the full realization of the bearish reversal. Interestingly, the downtrend line from the double top has indirect influence in bolstering bearish strength around 1270, where a spread out triple top and gap fill region present unfavorable conditions to an ascending triangle that rapidly fails. Even after so many years, the long-term downtrend line is helpful as there is normal bullish to neutral price action after it is crossed.